Now joining me to discuss the MPC's decisions are Bismarck Rewane, the CEO of Financial Derivatives, Chamberlain Peterside, the CEO of Xcellon Capital Advisors, and Gregory Kronsten, Head of Macro and Fixed Income Research at FBNQuest. I'd like to go to you first, Bismarck. As widely expected, no change, but did you hear enough from the MPC and, of course, the central bank governor in terms of how Nigeria is wading through the economic slowdown linked to the outbreak of COVID-19?
The first thing I must say is that I noticed that the optimism of the last meeting has been more cautious now, because at the last meeting we said by the third quarter, the central bank said by the third quarter we're back to positive growth. I think what I heard today was that the whole of 2020 is going to be negative growth, and that it will be a U-shaped recovery rather than a V-shaped recovery. So I think we are becoming more realistic and more realistic, let me put it that way. Secondly, there was silence or deafening silence on the exchange rate adjustment. There was also some silence, noticeable silence on the quantum of credit. You know, it talked about 18.9 trillion naira, but when you take it in the context of a 150 trillion naira economy, the impact of 18.9 trillion is not going to be that impactful. So there's work to be done. But also the thing is that the inflationary trajectory, in spite of the fact that disposable income is being squeezed, and the adjustment to the price of petroleum, refined petroleum products, I think we should be expecting the inflation expectations, and it's more important than historical inflation. What should we be expecting? And what level of inflation can we live with, which will not put us under pressure? Because if you say interest rates, treasury interest rates are 1.95 for 90 days, and inflation rate is at almost 13%, all of a sudden you have about an 11% negative inflation differential. That itself, by so reckoning, I think means that we are going to have a reduction in national savings, and by implication, pressure on the external sector of the economy.
All right, let me go to Gregory. And Gregory, just following up on the points that Bismarck just made about the inflation expectations, I wanted to get your thoughts on how the monetary authorities can actually deal with that challenge, because as Bismarck said, there is likely to be more capital flight linked to that negative real interest rate return that most investors are getting in Nigeria. So how do we fix this, if at all?
If at all. Well, I think, just go back very quickly. So what we had is what we expected this afternoon. And as Bismarck is saying, so they've toned down the growth expectations. But I should say, those expectations are still higher than quite a few people. I mean, notice the IMF has gone out to more than 5% now for Nigeria this year, for the shrinking of the economy. But direct answer to your question, well, the inflation, it's very sticky. I mean, the point is, we know the condition of domestic demand. You don't have to look at what listed companies are reporting to see that inflation should be rather lower than it is. But we have all these huge supply side constraints, which are keeping us with double-digit inflation. So now, now we even had on the core measures some uptick in inflation. But again, for the regular headings, if you like, those which are affected by lockdown, like pharmaceutical costs and hospital fees. Now, the point is the connection you're making, Kenneth, between the capital flight and the foreign investors. I mean, the point is, bills, bonds, the yield now is below prevailing inflation. But think you have to put in a competitive context. Might want to go. A lot of them have left, but that's really because of the unmentioned pipeline in repatriation, which hasn't happened, which has been in place now for 4 months now, actually, March the 20th. So I think that your foreign investors, the rump remains, and a few others, and if you ask them where Nigeria stands, I think what they're telling us the whole time is they're waiting for the pipeline to be cleared and for some clarity. I mean, I don't think they're that wound up by unification, to be honest, but they want to know that they can exit when they will. Now they can't exit at all, so they're not coming in.
All right, let me go to Chamberlain. And Chamberlain, of course, one of the big concerns of foreign investors, and of course, even the ordinary Nigerian, is what we've seen with the exchange rate recently. Now, we know the central bank has allowed some adjustment to that. I think you could say in the I&E window is somewhere closer to 381, but many are still suggesting that that is far from what it should be if we're going to attract any significant capital flows. I just wanted to get your perspective on the scarcity of foreign exchange in Nigeria today and potentially how you think the authorities can fix that.
Well, you have to realize, thank you so much for the question. You have to realize that most of the forex liquidity in the market usually are sourced from oil proceeds, a large part of it. And therefore, the pressure we've seen on oil prices has now translated in the scarcity of forex in the market. It's like a catch-22 situation where you would say, should we reduce the valuation of the naira to be able to attract additional incremental foreign investments? It's a little delicate situation there, because the more the naira declines, the higher you're going to have price pressure, not only on consumers, but on manufacturers who mostly source their raw materials from abroad. So there has to be a balancing act, if you ask me, that the central bank has to carry out. Fortunately, we've had 3 years whereby the rates have been relatively stable, and that kind of had made for a rebound in the GDP growth and also relative stability in the consumer price index. Unfortunately, with the mix of the global pandemic, the decline in oil prices, and of course, with our high debt ratio, it's begun to cause some fiscal pressure on the system, and therefore that is translating into weaker naira. For those who advocate that we should weaken the naira a little bit more to attract incremental foreign investments, I would say they should hold their breath. That's my view. Let's take a much more gradual and systematic approach in weakening the naira. Ultimately, if you look from 2014 and 15 up to this point, the rate at which naira has declined is totally unprecedented. And for the economy and the consumers and manufacturers to still be standing, we have to be very, very cautious. So I would say, if from now till the next few quarters, if we see the naira sliding by 5–10% more, then that would be much more realistic than some advocates who have said naira might hit 500 to $1 or beyond before the end of the year. The shock, the impact on the economy, even in light of the current global pandemic, would be very, very devastating.
Right. Bismarck, I want to come to you and really talk about the economy in general. The growth prospects, many will suggest, have perhaps even deteriorated. I did note that the central bank governor was less bullish about a rebound. At the last meeting, he suggested that we could possibly avoid a recession, but today I think he more or less confirms his expectations that we would certainly confirm a recession when we see those GDP numbers for the subsequent quarters. But I wanted you to speak to what the fiscal authorities need to get to work at now, because clearly the central bank won't be enough to fix this challenge. It's really a significant economic decline that we're seeing. It's an opportunity, many will suggest, for Nigeria to really reinvent itself, recalibrate the economy. What would you like to see from the fiscal authorities? Bismarck, that is for you.
Yeah.
Yeah.
There are limitations. The limitations of monetary policy as a tool for dealing with the whole of the economy are there. That's clear. So I think we are over-laboring monetary policy as a tool for total economic unshackling the economy. However, having said that, the truth is that if you have a 150 trillion naira economy, $420 billion odd, and you're tinkering at the seams with 3 trillion, the entire economic sustainability plan is 2.5 plus the what the central bank is doing, another 1 or 2 trillion. So let us say 4 trillion naira. That's nothing. That's 2-3%. The multiplier effect on a 2-3% increase in investment or activity is not going to move the needle. You need to be more audacious. We have to do things, and that is why part of the things that will actually incentivize investors to bring in money, and domestic investors to invest rather than take their money out, is the whole question of the store of value. If inflation is at 13% and you are getting 2% rate of return, you are not going to, every rational economic agent is going to do that which is in their own best interest. So I think we need to make that clear. Therefore, should you tighten at this time? Not necessarily, but you have to do something to ensure that you can take away the excess liquidity in the system. How do you do that? Allow the exchange rate adjust in a manner that is systematic. So not whatever you're going to do, you need to do it to ensure that you can take out that liquidity. Don't forget, oil prices at this time last year were roughly $60, $65 a barrel, maybe slightly higher. Today we are celebrating $42, $41 a barrel. The exchange rate at that time last year was 360. Today we are saying the I&E window is 3. So you're only as good as how much you earn. So having said that, the question is that we need to have the pillar of investment. We've talked about consumer spending, which is the palliatives. We've talked about government expenditure in terms of supporting activities. But what we are not talking about is what level of investment is required to actually take this economy out. And we are not the only ones. Look, the South African rand, maybe sometime this time last year, was about 14 rand per dollar.
Because I know that you are part of the... Yep, Bismarck, I was trying to get you to be more specific, because I do know that you're part of the Presidential Economic Council that is advising the president. What are the specifics in terms of how the fiscal authorities can really shift the needle here if we're going to really wade through this challenge?
The fiscal authorities are working, and the Economic Sustainability Plan, which is a one-year plan, has a interregnum between the ERGP1 and ERGP2. So there's that activity. We are getting concessionary money from the World Bank, IMF, and part of the conditions for that is to allow for a unified exchange rate so that we reduce the distortion in allocation of resources. All of those things are work in progress and they're going on, but it's not a silver bullet. It's not going to solve this thing. There's time required. And the first thing is that the fiscal authorities have accepted the reality that this country had pre-existing conditions before COVID. So we are using the opportunity, one, to solve the pre-existing condition and to make some strategic decisions to deal with the structural problems that exist so that gradually we come out of it. So it's a U-shape. We're going to go down, we're going to languish at the bottom for a while and then come up. But we need to do certain things. those things are being done, and
Right.
the fiscal authorities have made it very clear that one, the unification of exchange rates, two, cost-reflective tariffs to encourage investment in electricity, which I think is going to happen in September. Then the fuel subsidy, because you saw how the fuel rates, PMS went all the way down to 121, and it's back up to 145, showing that we are going with the market and things. So once investors know that pricing is no longer controlled, then you will see investment, and then you will see growth that will follow that. So we are cautiously optimistic that doing the right thing, that there will be a recovery sometime in 2021, but definitely not in 2020.
All right, let me get back to Gregory now. And Gregory, let's take this to the markets and what you anticipate is likely to happen over the rest of this year. Can you just speak to your outlook for the fixed income market in terms of yields? Given the central bank stance, the central bank governor already has noted that he expects a recession. Clearly, we cannot anticipate any tightening, in my mind anyway, in that type of environment. So what are your expectations for yield?
Well, thank you, Kenneth.
Hello,
so, we might have thought that because the DMO is meant to be raising 1.6 trillion naira from the investing market in local currency, and incidentally will hit the target, I've no doubt. You might have thought because of that, well, yields would be widening again, but it seems what we've had, in fact, is the opposite in quite a marked direction. And this is with the support of the liquidity that's made available at key points for domestic investors to buy bonds, basically, above all. So the bond market now, there are very few foreigners there. So the combination is the PFAs, as we know, and the domestic banks. So if you look at the last few DMO auctions, I mean, they've been pretty successful. At X, they've raised X plus, 50% to 100%. The stock rates have come off a little. And additionally, then they also fall back on non-competitive bids. Months ago, I would say, oh, well, the yields are going to be widening. There's so much debt, the market will be flooded with FGN paper. But the reality is that the yields have gone the other way. And it's hard to see retracement, Just go back to see what happened with the T-bills. The T-bills rate after the CBA changed the rules about who could access OMO. Then the PFAs piled into the T-bills, and the rates plummeted. So we haven't got there yet. We haven't got there yet with FGN bonds, but I think the trend is where we are now, or even slightly lower.
All right, Chamberlain, I want you to speak to domestic investments and the outlook for that. But before you do that, I want you to also comment on what you were expecting from this MPC decision. Were you disappointed in any way, or was it pretty much what you expected? And then please speak to your thoughts about how the environment is likely to play out for domestic investors.
Yeah, first, I think I would side with the two members of the committee that voted for a reduction in the NPR. My expectation was that there would have been, should have been, a reduction like we saw in May, especially because we are still in an environment that the pressure on the economy caused by COVID is still very much there. The outlook seems much more tepid in terms of recovery. We're not going to see that this year, as Mr. Bismarck told us. It's going to be a U-shaped recovery looking towards 2021. So I thought that there should have been those factors taken into consideration in adjusting the NPR. But that said, let me take a much more macro view on something that the governor mentioned, and which is creating that fund to invest in infrastructure, a fund that is exclusively targeted on Nigeria, but that will be able to attract foreign investors, and then specifically looking at investing in key large-scale infrastructure projects. Now, my view is that one of the key drivers, which is not a secret, for domestic investments, for GDP growth, is infrastructure. We've had this years of huge infrastructure deficit. And each time there's a major project that we need to take on, we can't do that without foreign investors, okay? And there have been discussions and debates on whether or not we can tap or leverage the pension funds. How do we do that? So as we sit and stand where we are right now, I think that we have underutilized domestic investments for infrastructure growth. And I think that's one key element that I took away from this meeting today. The longer we stick to fiscal adjustments, interest rates, inflation rates, exchange rates, and the less we pay attention on how we do the heavy lifting in physical infrastructure assets, then I think we would be hurting ourselves over the long run. So I'm quite enthused about the fact that over the next 5 years, you're going to be looking at raising 15 trillion naira. That translates somewhere around 10% of our current GDP. I know that is not a lot, but a 15 trillion naira fund over the next 5 years can truly make an impact in our power infrastructure, our distribution system, our logistics, that will be able to evacuate agricultural produce and open up new territories. So that's, to me, a key takeaway that truly runs against the grain of what and how central bank have been going about trying to stimulate the economy. Yes, all the activities with the targeted funds for SMEs, they're all good. But the big bang, you need the big projects that can only be carried out by CBN with its development partners. You can't leave that to the private sector, unfortunately. The private sector is weak. They lack liquidity, they lack the strength. So if you get central bank working with the Sovereign Wealth Fund and AFC coming together, I think we're bound to begin to see some turnaround that would hopefully bring us back to some reasonable growth rate, maybe 3-5%, maybe double digit over the next 3-5 years or beyond.
All right. Bismarck, I want you to speak to another point. Chamberlain was just speaking to his thoughts about the infrastructure company that the central bank spoke of. It's going to be a CBN-led infrastructure company. It's going to have the AFC, the NSIA, and the central bank involved in getting it together. There's a target to raise 15 trillion naira. Many will argue that for that to succeed at all, it's really a case of making sure policies that could attract those investment funds into infrastructure are in place. But before we get to that in more detail, I want you to speak to another point that the central bank governor raised, which was the gold purchase framework. It has been touted as a way to shore up our reserves to some extent. Are you optimistic that this can work?
It's a good idea, but when I listened, they said the total amount of gold bought was $286 million, which is 260 million naira, which is less than $1 million. Our reserves are $36 billion, so this is less than 0.001%. So again, I always put it in the context of impact and materiality. So it's a good gesture. But I want to come back to the point about 15 trillion naira. There are what we call fiscal responsibilities and there are what we call monetary policy responsibilities. Monetary policy responsibilities are clearly defined as price stability. The Central Bank Act is very clear. Price stability and to some extent, managing the exchange rate and external reserves. Funding infrastructure and all these things are not the responsibility. They're institutions that are charged with that responsibility which will do that. So I think the central bank is seeking to work with those institutions that are charged with this particular goal. So I think that has to be clear. Because if not, you will have one part of the government cannibalizing the other. I think that has to be very clearly defined. But the other thing is about how do you mobilize savings when there's an erosion to the value of the naira. No, I'm not talking about its exchange rate position, but just the fact that if you kept your money under your pillow at the beginning of the year, and at the end of the year, you will buy things that are 14% or 13% less than what it is. So you would rather invest in some other things. So the whole store of value and medium of exchange definition of money is extremely important. And to expect that, because the central bank is talking about signaling, we are sending a signal to rational economic agents to do that which is efficient. And so we need to understand that also there would be, money is fungible. They could move money out, move money in, invest if they're going to get value. So at this point, this is a crisis point. Pandemic is global. But we should bear in mind that at the same time, we are beginning to see some slow recovery, and therefore people have to be encouraged and incentivized to know that investing in Nigeria means that you will get a return that will be higher than the rate of inflation. I think that's important to note.
All right. Gregory, I need you to make this quick because I am running out of time. I want you to comment on your outlook for the currency, the exchange rate. We've seen the central bank adjust the exchange rates twice over the last few months, but we continue to see the weakness in the parallel market, which suggests that that is still a problem in terms of the dollar supply. How do you see things trending moving forward for the exchange rate, and potentially where do you see the supply of dollars coming from?
Yeah, well, it is a problem. You're absolutely right. But I think we have to bear in mind what the mindset of the central bank is. So all this talk about, we'll let it go to 600, and it's all just pie in the sky. The point is the central bank has a mindset. The mindset is make adjustments when you have to under pressure, try and keep them small, then try and hold the line, try and administer, try and guide. And that's how the central bank, and many other central banks for that matter, operate. So therefore, I think, these tensions are going to continue in the months ahead, because the two obvious places where you'd expect to find transformation of the supply of dollars, one would be the oil market, and the other one, of course, would be the portfolio investors. But the portfolio investors are not going to come rushing back because of the said pipeline of delayed repatriation. The oil market, well, in terms of where we are on the budget, the assumption of the budget, the oil price doesn't look bad. This is all very true. But in terms of transforming supply, it doesn't look good. Meeting the output restraint to which all members are bound. So the Nigerian government says that it's going to, yes, it'll comply, but in its own time. So Vic, to answer your question, no immediate solution, and tensions and raise a series of further slow adjustments by the central bank.
All right, Gregory, thank you so much for your comments, and of course for the analysis of all my guests. Thanks to all my guests today. Our coverage, that ends our coverage of Nigeria's Monetary Policy Committee meeting. Many thanks to Bismarck Rewane, the CEO of Financial Derivatives, Chamberlain Peterside, the CEO at Xcellon Capital Advisors, and Gregory Kronsten, Head of Macro and Fixed Income Research at FBNQuest.